Now we shift our focus to Europe, and we're going to look at, just start off with something a bit more global, but it's important because it's something that was impacting Europe more than other places, specifically on global shipping containers. So before we get into it, again, please like, share, subscribe, and especially on this segment, we'd like to hear your feedback. What would you like to hear more of, less of, just to try to get more traction and interest in the European segment. So when we look at global shipping container shortage, it's starting to balance out a bit when we look at 20-foot dry cargo, 40-foot dry cargo, 40-foot high cube units. We're starting to see some abatement in that balancing, and you're seeing that the reading of 0.5 denotes a balanced market. This is going to become a much bigger focal point as we get some balancing into the U.S., specifically on the West Coast. The biggest disconnect, as we showed last week, was the from China to Rotterdam, and now that's starting to abate a bit, which, again, this will also help pricing because, as we showed, the Baltic rates exploded. You want to see some of these adjust on the inflation side. So this will be a positive for cost. We're still not balanced. We're not there yet. But, again, it's getting a bit more normalized, and we don't think it gets back to that 0.5, but more along the lines of just trending up as we start to see some of the supply chains catch up with themselves. And the reason why we talk about this is the Eurozone price indicators and what does that mean in general. So when we look at July of 2008 and you look at core CPI, kind of where things are headed as we look at import prices, this is an interesting backdrop as we now look at Jan 2020 into today. And what are the ramifications and the reasons why we think that there's going to be a backdrop of what is CPI, what is core CPI, because there's a shift in what are the impacts. Because when we look at Europe in general, food is up 4%, energy is down 6%, 5-6%. But are they really seeing 5 to 6% down as there remains lockdowns, as stringency indexes increase in Europe? So as stringency indexes increase, you have countries that either have curfews, lockdowns, restrictions. You're inherently not consuming energy, so it's not really saving you much, but you're getting your food, your staples are going up in price. And this is that disconnect where is it going to get worse as Lagarde comes out and does more to weaken the euro and try to adjust kind of this balancing act? Because import prices have obviously gone down because euro is so strong, but you want to see export prices. Like the export prices, again, this is going to be this weird balancing act of how do they stimulate the economy while weakening the euro, but not weakening it too much. And this is going to be a very tight needle to thread, if you will. So when we look at the Eurozone retail economy, again, these are things that we continue to look at in general. So the U.S. has slowed, Asia Pacific is starting to slow, but Eurozone is the one that has seen the biggest drop off, which we think is continuing just when we look at where things are in general. Eastern Europe, and so the two that we see the biggest risk to remains not so much the Eurozone because it's already seen the drop, is really the U.S. and APAC, which is the Asian Pacific, just given the issues that we've seen on the resurgence of cases, some additional lockdowns that are going to hit that underlying, that retail movement, and the Eurozone retail economy rapidly lost momentum. And that's one that we think is going to continue to lose momentum. But it's just the pace of decline will be more Asia-Pacific U.S., where the Eurozone will continue to see the degradation, but it's just the pace will adjust a bit. And that's why when we look at European PMI slide expected to continue as lockdown measures ramp up. Coming back to retail sales slowing, we see UK lockdown, German lockdown stringencies, all of these coming back up to the highs, where the UK composite PMI is rolling, Germany composite is starting to go down. But we have to consider, what is it's still an expansion, but how sustainable is the expansion as we're starting to see some of this weakness coming into the market in general? And that's going to be, I think, a bigger problem in just overall when we think about what is the ECB doing. So the Governing Council will continue to purchase under the Pandemic Emergency Purchase Program with a total of about 1.9 trillion. The Governing Council will conduct net asset purchase under the PEP, the acronym, until at least the end of March 2022. Until it judges, the purchases under the PEP will be conducted to preserve favorable financing conditions. But the issue remains is equally the envelope can be recalibrated if required to maintain favorable financing conditions to help counter the negative pandemic shock to the path of inflation. So right now there's a problem of they may not be able to do it fast enough. So can they speed up the rate on which they're doing, and can they add more to it to try to do a bit more purchasing, not just at the government level, but also at the corporate and trying to get money into people's hands that need it most, given the stringency indexes and the problems that continue to permeate throughout the European Union, especially on the retail side, which continues to see headwinds as we go into as we really start off Q1 at this point. And then this comes back down to population and what is the population growth in general. And when we look at what is happening, and this is looking a bit more at emerging markets because we talked about the US, well, let's look at emerging markets a bit. And here you can see the population growth will be slowing in some of these key areas. Not so much, India has seen some pretty steady growth, but at the bottom end, and when we required growth in 2022 to 2035 under different job scenarios, you can see that the pain continues in terms of improvement in employment ratio. And we keep coming back to this because we need younger and younger individuals to help adjust some of the slowdown. So where the developed market's seen a big slowdown in childbearing, we've seen an increase in emerging markets. And this is where we start coming into migration. How can we get some of these individuals to coming into the developed markets, which is kind of that natural flow, or then how will they see that growth within the economic backdrop, which is interesting to see, which is why China, that CNY, is on the negative end, and really that employment ratio remains a problem in general, which again is going to become a bigger problem on the longer term versus in India when we look at that China-India conflict in the next segment. Now, the moderate increase in interest payments, it continues to get worse. And the reason why we talk about this right now in the Europe segment is because Europe is a fairly large owner of some of this debt, as is the U.S., obviously. But the Europe has an outsized exposure to some of these countries where when we look at kind of that baseline, South Africa is in a world of hurt regardless of what happens. But when we look at emerging markets in India, that is where we see some of these rate shocks that could become a much bigger problems, just emerging markets in general. And this is why when we look at what is the euro going to do, what is the dollar going to do, you have to appreciate, well, how much is the pain that the emerging markets are going to experience, and will they have enough money to pay off some of this debt that we've seen get kind of filtered through the system as debt has continued to grow across the board. And that's when we look at the outstanding market debt by currency. The India has a lot of local currency debt, which is a net benefit in terms of that payment because they're really borrowing in their rupee instead of having some of this exposure internationally or local currency inflation linked again. But they might have to do more to incentivize and to pay back some of this debt. So this is going to be an interesting dynamic to watch as we start to get into what we hope to see is a recovery, even though emerging markets have slowed, really driven by the Asian nations at this point. And when we look at the ECB, so when we talk about what the ECB has done, what they expect to do, so the ECB have absorbed 85% of net Eurozone government issuance in 2020. And you can see just where that leverage is, in terms of Italy, in terms of Portugal, with Portugal announcing their deficit is bigger than expected due to slow revenue gains. Italy just increased their stimulus by 32 billion euro. So again, this is why when we talk about the PEPP what Lagarde can do, what is their ability to try to stimulate the economy, and again, how many issuance can you go? Where is it going to go? How much can the European Central Bank essentially purchase this negative yielding debt as we have this perpetual cycle? And when we look at the Bank of Japan and Japan in general, it doesn't matter. They're in this perpetual deflationary stagflation cycle, even though they own 87% of different ETFs. Like, at what point do you just, the central bank owns it all, and then what? And that's where you have to have this business cycle normalized, and we're just seeing that stymied in all these different directions, which is, I think, a bigger problem overall. And again, looking at the negative rates, investors consider further cuts to ultra low interest rates unlikely. So that is the expectation. So the expectation is here, but Lagarde came out and said, it's not. We have more we can do. We can take this further negative. And again, this is where we start getting into this unknown territory of what is the output, what is the pain in general as we continue to see some of these issues reverberating through the system in general. And that's when we start turning to, well, what is some of the economic data? Well, let's look at the PMI numbers, and let's look at France. So France manufacturing in January, 51.5 versus the estimated of 50.5. Services, big miss. Expected was to be 48.4. Instead, it came in at 46.5. The composite was at 47. Contractionary. Again, France is contracting. We keep getting these different contractions in general. That is becoming a much bigger issue because France is a very large part of the underlying strength of not only the euro, the European Union, but also just how quickly can they get out of this recession. Germany manufacturing, was a little bit below expectations, still an expansionary. Services beat pretty handily. The other expectation was from 45. It came in at 46.8. Still contracting, but better than expected, which put the German composite at 50.8, which is right in line. You're not really expanding, you're not really contracting, you're kind of holding the line in general. But the view as we look at toll miles, as we look at some other, even further leading indicators, this is going to continue to roll over, and we will start to see additional pain, as we talked about earlier, with the stringency index going higher throughout January, which will impact the underlying component. Eurozone manufacturing, again, on the back of Germany, on the back of France, because Italy did miss and missed on the negative side. Eurozone manufacturing was expected at 54.4, came in at 54.7. Eurozone services, kind of right in line, 44.5, came in at 45. Composite came in at 47.5 versus an expected 47.6. We continue to see contraction. We continue to see this gunking up of the system, which is inherently going to put more and more pressure on just, again, what can the ECB do? What can the governments do to try to incentivize and to stimulate the economy? Because we in the U.S. are already in positive territory. Even when we back out the inflation, when we back out a lot of that, we're still expanding. Now, we're not really in true growth because we had such a huge drop down at the beginning of this. It's bifurcated, but there's still at least some positive. We keep seeing these negative reactions within Europe, which is just going to hinder some of this developed market, some of these problems as we go forward. And then when we turn to the German IFO business indices, you can see that there's a big shift essentially across the board, coming full circle into where are we going to go? Where is Q1? So German business morale unexpectedly dropped to a 6-month low on virus woes. Business climate index fell to 90.1 from an upward revised 92.2 in December versus an expected 91.9. So again, people aren't feeling as confident. Expectation components dropped to 91.1 versus 93. Current conditions plunged to 89.2 versus 91.3. Again, this is in December. So the trajectory is going down. We have some PMI numbers that are, flattish but the trajectory is going in the negative direction. And Germany is really the only thing that has been holding up some of these underlying assets, which again becomes a much bigger issue as we start breaking it out. Manufacturing, flattish, and that we expect it to be flattish, but trade down, construction, starting to roll over, service sector rolling over and trending in the wrong direction. Trade is going to be the key part, coming again back to the euro. Where can they get the euro to try to incentivize more trade, to get those exports going in greater quantities, to try to drum up and support not only manufacturing, but services, because construction is flattish and it's not too much going forward. But the expectations are going in the wrong direction, especially for trade, especially for construction and service sector, which is just going to weigh on Germany, which just based, if we go on the aggregate, weighs on the total European Union in general. And this is when we start turning to, looking at CPI model from oil prices and average CPI in major emerging markets, where the inflation issues are not just in the US, they're not just in Europe. The problem is also going to be in emerging markets. And as you start to see inflation going up, it limits the amount emerging markets can continue to stimulate and or have easy money policies. So again, these are those issues where there's all of these landmines that keep getting created that is going to hurt some of these expectations, which is why when we look at European area economy in terms of what is the expectations still remain positive for 2021, and it's at, let's call it just over 4%. Okay, this is where we continue to struggle with a lot of these economic activity levels as we go into 2021, with the headwinds that we're going to outline again in China, the ones we've already talked about in the US, and the ones that we're highlighting now in the Euro area GDP, with Germany slowing, with the EU, with France taking a step lower. This is going to put weight and make it harder to achieve this without a significant amount of stimulus, a significant amount of ECB intervention, which again, at what point do you hit a point of law of diminishing returns where no matter how big the size, you're just not getting and purchasing the amount of power that you need, which again is looking at the Europe's biggest economies probably stalled or contracted in the fourth quarter. This is, again, looking at it from Germany, France, and Spain. The biggest issue is going to be where are these forecasts hanging out, because we saw a big slowdown into December. We're seeing January trending in continuing to track in a negative trajectory, which will put more and more pressure on just where is that 2021 expectation going to shake out, because right now Q1 is still too high. We have an issue on vaccine rollouts. We have an issue on stringency indexes. These are things that will mitigate some of the benefits and will take some of the forecast lower. Again, coming to energy demand, oil demand, just where things are going to go, it's just not a healthy situation. And that's why when we look at some of the European ETF issuers, where is some of the money going? Well, it's increasing in a lot of the thematics that we've seen in the US: water, biotech, technology, ecology, healthcare, alternative energy. These are things that we'll continue to see, because we talk so negatively about so many different things. Well, let's look at some of the other entities that have some opportunities and some of these mitigating factors. And this is where we look at water, biotech, tech, and this is where we see some of these benefits, where the ETFs will see themes, money flow will continue to move in there. So, we still remain positive on Poland and other parts of Eastern Europe. There's still something to be said, and there's still investments to be made, but you can see that obviously there's been a bigger shift, and it's going to be more focused and bifurcated in terms of, again, utilities, financial services, energy, consumer goods, losing investments, and a lot of that going to the other side that we just highlighted. So this is where we're going to leave off, and then we're going to pick up in the next segment looking at GDP adjusted for a lot of these stimulus, provide an update on India, China, and then really kind of go into some of the raw materials, especially when we start looking at that alternative energy side, because it's an interesting dynamic as we start to look at who controls those supply chains.